Does asset allocation still work, or do we need a new model for managing our portfolio returns and our risks? Well, it is difficult to discuss asset allocation without including David Darst, a prolific author, teacher, and practitioner of the topic. David is the chief investment strategist of Morgan Stanley's Global Wealth Management Group and author of many books on asset allocation and investing. And his latest, The Little Book That Saves Your Assets, has been a bestseller. And our next guest, Richard Bookstaber, is an asset allocation skeptic. He is an expert in financial risk management who has worked at major Wall Street firms and hedge funds, including Salomon Brothers and Morgan Stanley. Now on his own, he is the author of the book, A Demon of Our Own Design, that gave early warnings of the dangers of Wall Street's complex financial instruments, some of which he helped to create. And our third guest is financial planner and investment advisor Mark Rattazzo, and he brings perspective from the front lines of his work with his clients. Mark heads up his own firm, Macro Consulting Group, based in New Jersey, and his firm has been named one of the top 1,000 financial advisors in the country by Barron's Magazine. So thank you all for being here on Wealth Track. I appreciate it. David Darst, The Art of Asset Allocation. I'm going to paraphrase something that you wrote in that, and that asset allocation at its heart is a search for non-correlation, finding assets that will grow and behave in a different manner from other assets. Did it fail us last year?
Well, in many respects, it did fail us last year because many folks thought they had an asset allocation, Consuelo, but they really had U.S. equities and non-U.S. equities, emerging markets, developed markets such as Europe or Japan. Well, they all went down together when the market fell off a cliff starting in September, a year ago now, or a little bit more than that. The folks who did have cash, who had Treasury inflation-protected securities, who had 10-year Treasury bonds, which were up 20.4% last year.
Right, the golden example last year, right?
Compared to the Standard & Poor's being down 37.0% total return. The folks who had gold, which was up 5.8%, folks who had managed futures up 14%, those, we call them the four horsemen of the apocalypse, that really are very low or negatively correlated asset classes. So those folks, for them, asset allocation worked, and the loss.
If you had a lot of them, David, it worked. I mean, I think that's the point, because most people have more bonds, and not necessarily Treasury bonds, and they certainly have more stocks in their portfolio than any of the other asset classes that you mentioned. So it really, on the margin, they help, right? But
many folks,
you would have had to really beef up.
Consuelo, you've said this well in the past, some of our other conversations. They had a sprinkling. They had 3, 4, 5% of many of these things. The bonds are one of the things. If you had high-quality bonds last year, government bonds, high-quality municipal bonds, not crazy bonds, but high-grade bonds, which Buffett has always espoused. David Swenson, a guest on your show, of Yale, has always said, don't try to knock the lights out with bonds. Bonds are a protection device. And folks who had adequate allocation to bonds and cash, which tend not to be as fringy as the tips, the managed futures, the gold, those tend to be in smaller amounts, no question about it. But those folks, they managed to cut their losses in half or less. So their portfolios were down 11, 12, 15% versus the market being down anywhere from 38. The emerging markets, as you know, which we've talked about a lot on this show, they were down 53% last year.
So hold it there, because we're going to talk about, whether or not we need to rethink kind of the more traditional asset allocation. So Rick Bookstaber, you are skeptical, and you told me diversification works really well until it really matters. So what did you learn last year?
Well, I'd say that, of course, if you have a crisis and you take risk off the table, you're going to look better. So it's not a big surprise that if you only have 50% in equities and the other 50% in bonds, you're going to look better than somebody who's 100% equities. I don't know that there's much to say there. But the issue is, if you think that you're diversifying by holding a wide set of different assets, you're going to see that diversification work until there's a crisis, until it really matters. Because during a crisis, all that matters is risk. If something's risky, it goes down. All that matters also is liquidity. If things are less liquid, they go down. So in every crisis, equities drop, emerging markets equities drop even more, the yield curve flattens, volatilities go up, credit spreads widen, so corporate bonds basically start to look a lot like equities, and suddenly you discover that these best laid plans for diversification aren't doing anything for you. To me, that's a different issue. The diversification is a different issue than what you're talking about, where you're talking about bonds and stocks together. I agree that if you move some of your portfolio away from equities and towards bonds, you look better if the market turns down. But on the other hand, long-term equities tend to outperform, so you won't do as well on the way up.
When we're talking about risk, so the risk assets, which most people think about risk assets are really being equities. So they talk about stocks as being the risk assets, even though investors have been told that long-term, actually, equities are a much better investment. They grow faster than inflation. They do better than bonds. But in the meantime, we're dealing with these. David's saying it. So you could have had the average 401k at a 14% decline last year, but that hurts regardless. Yeah. So the point being that broad diversification really can't protect you if there's a crisis. You've got to. You can't be broadly diversified. You've got to be narrowly diversified.
Right. Diversification
and riskless assets. Okay.
Yeah. So diversification isn't going to help you.
Right.
But deleveraging will. Mm-hmm. But there's a price to pay from deleveraging.
And deleveraging, you mean what?
In other words, instead of being 100% in equities, say being only 50% in equities. Mm-hmm. You will do better if the market turns down if you're only 50% in equities, but you'll also not do as well if the market goes up.
Right.
So you're just taking risk off the table. That's a different issue than trying to diversify, and that's not a big issue in terms of asset allocation. That's simply determining where you want to set your dial in terms of risk taking.
Right, okay. Mark, does asset allocation still work as far as you're concerned? Or do you define it differently?
I think that the reason that people go to asset allocating is to have various asset classes, small cap, mid cap, large cap, et cetera. When a lot of the analysis was done on this, the U.S. markets, the European markets, the Asian markets acted very differently.
Right.
And we could be having a great time while Europe was having a difficult time. The world has gotten a lot smaller. We did a graph on correlation over the past 5 years. International indexes and U.S. indexes have better than 90% correlation. And
which actually we showed in the opening of the show, so thank you for that graphic. Mm-hmm.
Well, buying those and rebalancing between the two they were both going up similarly and down similarly. It didn't help. And so there are other asset classes that have long-term strong rates of return, like managed futures, that have a negative correlation to equities. And by owning them both, managed futures were up 18% last year. Mm-hmm. Equities got hurt. We own both of those, and the interesting thing is now the managed futures piece is not doing well, and people who own it are saying, well, should we get out of that and buy stocks? Well, it was what saved you last year. The toughest part about asset allocation is discipline and sticking with it. I got made fun of or poked fun at in the Wall Street Journal in February of 2000, talking about why you shouldn't have all your money in growth stocks and tech stocks when the NASDAQ was at 5,000. People don't want to talk about risk management and diversification when they need it the most.